Hey, I'm Jason Schmitt. I'm your city treasurer, and we are back for the fourth installment of our financial literacy set of workshops with United Way. Last time we talked about credit unions, commercial bank accounts, and online bank accounts, and today we have some folks here with us from the Huntington Beach Credit Union to spend a couple minutes talking about the credit union experience and one of our local opportunities with regard to that. And then we're going to turn the chapter forward, and we're going to talk in Module 4 about savings and debt. This will be the fourth of 5 modules we're going to have, and the last one is going to be on credit cards and all kinds of other forms of debt, so you're definitely going to want to be here for that. So I want to start today with a pop quiz, and I can't wait to see who knows the answer to this. So if 20 years ago you had taken $100 and invested in something, what is the thing that you think would have gotten you the highest rate of return?
Obviously would have been stock market.
To the S&P index. Okay, that's a good guess. So if I had to guess, I'm just going to turn the clock back. I'm going to guess the S&P index on average is probably returned, we can look it up, but I'd say maybe 15% a year. So I have a better investment for you. It's a much better investment. It's in your pocket right now. So take out your wallets. Take them out. I bet every single one of you has this investment, and you just don't even realize it. Okay, give me your wallet for a second. Sorry, I'm not going to take the money. Let's see, do you have the investment? This is the core question. Wow, you do. So I'm going to show you, and it's not their stock. It's this lovely Visa card, courtesy of Carmine. So, do you know why this is the best investment you can possibly make? Your best investment return. What do you think is the average APR on the debt that's associated with that credit card?
18?
Yeah, I'm going to look to you. What's the exact number? It's probably 23 is my guess.
Yeah, around, yeah.
23. So if you'd paid off that credit card, you would have earned 23% a year by paying off that credit card. Better than you would have done by taking that money and investing in the stock market. So that's what we're going to talk about today. We're going to talk about how do you save more money to give yourself peace of mind, and then how do you make sure you pay down that debt so that you don't have that and you get a 23% return, an ROI, which is return to yourself.
Hi everyone, my name is Zachary Kirschman. I work at Huntington Beach Credit Union. We are a credit union located inside City Hall. We were established in 1953 as the Huntington Beach City Employees Credit Union, but now we're the Huntington Beach Credit Union. So as long as you live, work, worship, or go to school in Huntington Beach, we're a local credit union that supports exclusively Huntington Beach. We offer online accounts, loans, all sorts of good products, checking, savings. So if you wanted to check us out, feel free. My name is Zachary Kirschman, and I'd love to help you guys get an account with the credit union. Moving forward, so again, these classes are provided through SparkPoint OC. It's a free financial coaching. It's one-on-one. It could be in person or through Zoom, whichever you prefer. It is a 12-month commitment, but again, you meet with them one-on-one, talk about your finances. If you want to improve your credit score, you want to reduce debt, you want to increase your savings, they make a personalized plan with you. So if you are interested, you can scan the QR code or you can go directly to the website. That's going to be our interest form. And based on your location, we're going to connect you to the closest location to you. So we do have over 9 sites in Orange County. So depending on where you're at, we're going to connect you to the closest one. Okay. Any questions on SparkPoint, the program? No? Okay. So we do have other resources. So we do have Upskill OC, that one's for workforce development. So if you want to get a certification in technology and healthcare, they do help you with that. They do have a scholarship that they're able to provide to you to pay up for a portion of the program that you're doing. They do help you with your resume, things that are going to prepare you to get a job that's within the living wage of Orange County. If you're interested, you can go to the website. It's similar to SparkPoint OC. You're gonna talk with the case manager. They're gonna see if you qualify for the program and then work with you after that. We also have the OC free tax prep, so you can file your taxes completely free. We have over 30 locations throughout Orange County. So again, if you are interested, you can go ahead and go to the website. It's going to show you the locations that we have available. And you can give them a call. If not, you can also dial 211. Let them know that you want to book an appointment for taxes. They're going to ask you for your address, and they're going to send you to the closest location as well. And with that, we have 211, which is a resource center it's like a call center for different resources. So they don't provide the resources, they connect you to the resources. So if you need assistance with utilities, you need assistance with mental health, transportation, food, anything like that, you call them, they're going to connect you to a nonprofit within Orange County that's close to you. So we'll move into today's class. So today we're going to be talking about savings plan and managing debt. So we're going to go over briefly why it's important to have a savings plan, and also a little bit more focus on an emergency fund, just because sometimes emergencies happen. We don't have those funds saved up for that specific emergency. So what happens is that we get into debt. And we also want to help you find ways to get out of your debt. So we have two methods that can help you, and we're going to go over that later as well. So what does savings mean to you? What is savings?
Putting money aside.
Putting money aside? Yeah. Mm-hmm. Yeah. Okay. And then is spending less money the same as saving money? If you spend less, do you save money?
It's like, wouldn't that be more like budgeting
Yeah. It could be budgeting. Yeah.
instead of saving? Savings, like she said, like putting money away.
Yeah. Yeah. So you are able to save money when you spend less, only if you put the money aside. But if you don't put it aside, it's not saving, so you're just spending less. I know sometimes we go to stores that have discounts, and we think that we're saving money because we got a product for 50% off. But we're not actually saving, we're just spending less. So there's the difference with that. With savings, like we mentioned, it requires that we put money aside. Someone mentioned budget. We also have to look into our budget to see where we can maybe save money, maybe where we can reduce some of the expenses that we have, or maybe even eliminate some of those expenses.
Some comments in the chat. Somebody mentioned savings is money for the future, or money that I don't use for everyday expenses is what I consider savings.
Yeah. So money is for the future. So you're saving for your future. Sometimes we don't think about the future. Sometimes we're just in the present, buying things, buying items, and we don't really think of what's ahead. So yes, saving money is also for the future. Thank you. And why save money? So there's different reasons why you may want to save money. So maybe you have goals. Maybe you have a goal to go on a vacation. Maybe you have a goal to just save money for any emergencies. And that goes into the second one, emergencies. There's a lot of times that emergencies happen and we don't have money saved up. And again, what ends up happening is that we either get a loan or we use our credit cards. And then that makes us go into debt. Also, sometimes we have less income or more expenses depending on what type of job we have. Maybe during the holidays, we do tend to spend a little bit more money. There's also times that, again, maybe we have a profession that we only work 9 months out of the year, so we don't have an income for those 3 months. So what can we do for those 3 months? It's save money. Because we already know, we have an idea of how much money we spend on a monthly basis that we can save up for those months that we don't work. It's also peace of mind. We are more relaxed, we're more calm because we know that we have a savings set aside. So if something happens, maybe we don't have the full amount. Maybe we only have a portion of it. But a portion is better than having nothing because now we're not compromising our future income as much. Also for getting and keeping a job. So if we are applying for jobs, we do need to buy clothing to look presentable. We do have to have transportation. So it does require money to get and keep a job as well. And maybe you have other reasons. You know, there's many reasons that you can choose to start saving money. Maybe you want to save money again for a new phone, a new laptop, a new TV, a new appliance. So there's different reasons why you may want to save money. What are some of the reasons why you may want to save money or why you're saving money?
Retirement.
Retirement? Mm-hmm. Yeah.
Vacation.
Pension? Yes. Anyone else? Yeah.
I'm considering like furthering my education.
Okay, your education, yeah.
Move towards a master's.
Yeah. So yeah, for education as well, yeah. Mm-hmm.
Sometimes
sometimes it's for losing a job and you don't have income.
Yeah.
Somebody
Yeah.
mentioned emergencies. in the
Emergencies, yeah.
chat.
Yeah, so as you can see, there's different reasons why we may want to save money. It's just about us finding the reason, because it is really difficult to start saving money. It is really difficult to start setting money aside when we don't have a reason. Maybe we don't think of a reason, and it's really hard for us to start saving money. So if we find a reason, it's going to be more easier for us to start saving the money. Even if we start small, if we can do $1 per week, let's start with $1. If we can do more, let's do more. It's about starting the habit, just because it is a habit that we need to have. So if we start small, again, I said $1, but if we have less than $1, let's do the few cents that we have, just because we want to create the habit. For when we have the income, we are already having, again, the habit of saving money. And going more into emergency savings fund, again, it does take time and commitment. It is a cycle. Sometimes we use our emergency fund and it's zero. We are back to square one. A lot of us get unmotivated. We feel like we did all of the work for nothing, but it was for a reason. It didn't help us in that situation. And if we were able to do it once, we are able to do it again. Again, it does take time. It is a commitment, and it is a cycle. It's worth doing. Again, it's going to help you. And it is an important step for your financial health and your stability, your financial stability. Just because if you don't have savings and you're working towards your debt, if something happens, you're putting more of your money into your debt, then you don't have money set aside for emergencies. So if possible, start your savings and then work on your debt. Other people like to do it the other way around. So depending on what's your preference, if you want to maybe get rid of your debt and then save money, up to you. I recommend doing saving money first and then working on your debt, just because then you have something, a little cushion that you can rely on. And again, anticipating changes to income and expenses. Usually during the holidays, that's when we spend the most money. And we already have an idea how much we spend during the holidays. We already have an idea how much we spend for events, for celebrations. So we can already start saving money from the beginning of the year to the end of the year. So we already have an idea how much we are going to spend. We can do that. Also, some people like to buy items as the year goes. Sometimes they have a sale, they can, buy an item like that. So there's different ways that we can anticipate for those changes. Again, maybe we are a teacher that, we only work 9 months, 3 months, we don't get paid, depending on how you have it set up, but for the most part, we don't get paid. So what can we do? And I believe credit unions do have a plan for teachers, also for other people that may not have a full-time, a year-round job, they do help them with that. So, And one example of how we can save money for our goals, in this example, we have a new TV. And we have the option of doing every day, weekly, on a monthly basis, or yearly basis, depending on how we want to save money. In this example, the cost of the TV is $400, and we want it within 6 months, so that's about 25 weeks. If we get paid weekly, or we prefer doing weekly, we're going to divide $400 by 25 weeks, and that's about $16 per week. So that seems a little bit more manageable than thinking about the $400 in one at a time. So if it's maybe bi-weekly, every 2 weeks, that's going to be $32. Again, it seems a little bit more manageable than thinking about the full amount at once. And the example that I have in here is for a new TV. It could be for any example. For any example that you just have to know the cost of the item, for how long you want to save, and then start saving that up as well. And you may want to add a little bit more to your goal, just because prices do change over time. So they don't stay the same. Maybe it's a little bit more expensive by the time that you have all of the money. Any questions or comments on this?
Another good point would be that if you do it that way, it isn't impulse buying, which I think a lot of us get involved with. So,
Yeah,
give you time to think about.
Yeah, so if we have a goal, it does usually prevents us from impulse buying. It happens to me. I have goals that I want to save money for, and then I see an item, say a product, I want to get it. So for the most part, I have learned learn techniques to help me with that. And there's different techniques depending on how you are. For me, it helps that I have to pause for a second. I don't just go and purchase the item. I wait. If it's through Amazon, I put it on the cart. Wait a few days. If I don't buy it, then it just stays on the cart, or I remove it from there. So there's different ways that we can, prevent from impulse buying. Are there any techniques that you use?
Sometimes I have to ask myself, do I need it or do I want it?
Mm-hmm.
If I could
Yeah.
be that cognizant to
Yeah.
stop.
No, so yeah, thinking about is it a need or is it a want? That usually helps as well. So yeah. Anyone else? What are some techniques that you have to prevent you from spending money?
Like you said, I just add it to the cart, and then I'm like, if I wait 5 days and I don't decide I want it, then I just get rid of it, because that 5 days, it makes me question, actually, do I really want to spend the money to get it?
Yeah. No, yeah. And I know it's really difficult. I know it's really hard to not get those to make those impulse purchases, because it does make us feel good. It does make us feel good when we spend the money. What happens to me is that I feel bad after I make the purchase, like, did I really need to make this purchase? So, maybe waiting a few days could be more helpful for us as well.
Also, I think less shopping.
Yeah.
Less shopping.
Yeah, less shopping would help.
But the problem is, it's so easy to shop online now. You don't even have to go out and do anything. It's at your fingertips.
Yeah.
Time of day or night.
No, yeah, they made it so much easier for us to click and spend money. So, yeah.
Also, does it have future value? As this young lady pointed out, maybe towards an advanced degree, that has future value and that's goal-oriented. So it's kind of a different kind of spending. Sometimes you ask yourself, is this going to have future value to me?
No, yeah. So, thinking of the future, thinking ahead, is this something that's going to increase in value? Is this something that's going to be helping me? So, yeah.
I think Fan and the online mentioned using ad block to not see any ads, not use online shopping ads at all in a set time of period. And then his recommendation is also not using social media.
Yeah. No, yeah. Right now with social media, we see things and we want to have those things as well. So it is really difficult, but if we're able to stop ourselves from maybe comparing ourselves to other people, or maybe like, oh, we don't know their process, we don't know what they went through. So maybe that's a way for us to step back as well. But yeah, I didn't know about the ad block, so that's also helpful. You don't get to see ads that are trying to convince you to make a purchase. So yeah. So I'm going to move into where to put your savings. So there's a lot of options. I'm just going to focus on 3, which is your home, friends or family, and a savings account. Like I mentioned, there's other options as well. I'm just going to cover pretty much the basics, but there is other options. And each of them have an advantage and disadvantages. So for home, one of the advantages is that there's no fees, there's no rules, no one's telling us how to put our money, how to manage our money. There's no additional cost to maintain. It's convenient and it's easy to access. The disadvantages is that it could get lost or stolen. If there's a fire or something that's happening in our house, it could also be lost. And like it's an advantage, it's also a disadvantage. It's easy to access. Sometimes we are saving money at home and we say, I'm just going to grab $20 and I'm just going to put it back at the end of next week. Sometimes it doesn't happen. So, it's convenient to have it at home, but also it's inconvenient because we have that easy access to grab it. And then we have friends or family, similar to having it at home. The only main difference with the advantages is that it's not as easy to access. So it does keep us from accessing the money. We can usually tell the friend or family member to give it to us unless it's a real emergency. So, we can set those limits with them. And then disadvantages, again, similar to the home. The only main difference is that usually it does impact the relationship that we have with that family member or with that friend. I don't know if it has happened to anyone, but I know that there's stories of people that ask a family member to save money. When it comes to the time that we're asking for the money back, they don't have the money because they used it. So it does impact, our relationship with them. We stop talking to them. and maybe we don't trust them anymore. So again, there's advantages and disadvantages. And we're going into savings account. So this is where we want to have our money. We want to have it in the bank. We want to have it in a savings account. So some of the advantages that with a savings account is that it is protected. Your money is protected. If something happens to the bank, the credit union, it is protected. They do have protections to, again, protect your money. If you have a job and you get a direct deposit, you are also able to set it up to have a direct deposit to your savings account. That's something that I have. I'm able. The money goes directly to my savings account. I don't have to do anything. So it's easier for me to just have my savings without me having to do it. Because if I leave it up to me, I know I won't do it. So I do have those direct deposits as well. You are able to move your money as well. So if you have a checkings and savings, you can move your money between those accounts. Usually there is a limit though with how many times you are able to move it. You may also earn interest. So if you have it at home, you have it with friends, it's not going to earn any interest. It's not going to earn you any money. It's also easy to access. Again, it's with your bank account, so you are also able to access your money. The same with a checkings account. And it does help you establish a relationship with your bank. So you want to have a relationship with your bank, knowing that you have a savings, you have a checkings, maybe you can access other services at a future date as well. Some of the disadvantages that we have is that sometimes they do have a monthly fee. And sometimes there's ways to avoid that fee. So it's about asking the bank if there's ways for us to avoid that fee. It may not always be the best option for long-term goals, long-term saving. So if we want it for the future, maybe a savings account may not be the best option for us because, again, it does earn us some interest, but it's not going to be as high. So maybe other ways, maybe other types of account may be better for long-term. Yeah.
For an advantage, and I don't know if it's up there, if you said it, when you go to a savings account or an institution, don't you start getting information for the FICO score that you would be used in other things? If you have it at home, there's no, nobody knows what your FICO score is.
Yeah.
You don't do credit.
Credit, well, I guess so.
So yeah, usually it's with if you have like a credit card, you have a personal loan or a loan. Usually they do give you access to yeah.
You want to discuss the type of savings accounts?
So I'm briefly going to go over mainly the high yield savings, but I'm not going to go into too much depth of
High yield or anything like that?
just the high yield accounts and how much the percentage that they're providing right now. So yeah. Yeah.
I like that you shared a little bit about like your saving strategy. If you have a direct deposit, I'm curious if you choose like a fixed amount that you save, or do you go percentage wise and like what works best?
I have it set at an amount, specific amount. So because my paycheck does change from every 2 weeks, so it's not the same amount. So I do have a set amount. If you already know that you get paid the same, maybe you can buy percentage. Yeah. So yeah. Yeah. Any other questions, comments?
Yeah, sometimes I do like if I have direct deposit. Sometimes I do 80% in one account and 20% in another account.
So it's up to preference how you want to do it. If you want to do percentage, you want to do a set amount. It's up to you. Also, how much are you capable of savings? How much are you able to set aside? So it also depends on that. Okay. And then an example with interest and compound interest. So we do want an account that's going to be compound interest. So I'm going to go over the difference between just interest, simple interest, and then compound interest. So interest is the amount of money that you're earning, the amount of money that the bank is paying you to have your money safe with them. So in an example, you have a $1,000 deposit. Let's say that this is a high yield savings. You have 4% interest per year. Each year, actually, this is just a simple savings account. Each year you are earning $40. After 3 years, it's going to be $1,120. With compound interest, you have the same amount. We're going to deposit $1,000 at the same percentage, but this is compounded yearly. And compound interest, it's the money that you earn on the original amount that you deposited, and also the interest that you already earned. So I'm going to go over the example right here. So after the first year, let's say we will have 1,000, we're going to have 1,040 at the end of 1 year. At the end of the second year, we're going to start with 1,040 and we're going to end with 1,081.60 cents. Year 3, we're going to start with 1,081.60 cents. And at the end of that year, we're going to have 1,124 with 86 cents. So as you can see, the difference between just having the simple interest and a compound interest, it's going to be $4.86. And this may not seem like a big amount, but this is just keeping in mind that we're not adding more money. This is just those $1,000. But if you are adding more money to your account and you're making monthly deposits, that amount could also increase as well. So, and just another example, if we have it at home, we're going to start with this example at $5 per month. It's going to be $60 at the end of the year. With a bank that pays 2% interest with compound, it's going to be $60.55. And I want to go to the last one, which is year 30. So we have $1,100. So that meaning that we saved those $60 per year for 30 years, and that was the amount. It stayed the same. Over here, with a 2% interest compounded monthly, we saved $2,463.63 cents. So that's the difference between having it in a bank account and then at home. And for the difference between these two, I believe it's like $600, around $600. So maybe for those 30 years, that's not enough. So that's why I was mentioning that maybe a savings account may not be the best option. Maybe there's different ways that you can save your money, so it could create more money for you. So some savings account, this is high yield savings account, and also comparing with traditional banking and also credit unions. Some of the high yield savings accounts that are available is Capital One. Last time I checked, they had a 3.30% APY. Discover, they had 3.40. Amex, they had 3.30. And traditional banks like Chase, Bank of America, Wells Fargo, they do offer you a 0.01% interest rate, and then credit unions, it could be 0.07 to 0.10%. There's also different type of accounts. So again, whichever one may be the best, you can choose based on your needs. So, any questions on this? No? Does anyone have a high yield savings account? Yeah? Okay.
Can I point out one thing?
Yeah.
You can shop CDs at banks, okay?
Yeah.
They are constantly trying to attract new money.
Yeah.
Be aware of the terms.
Mhm.
You can also have them pre-notify you when the term is getting near. Very
Yeah.
important, because you don't want it to sail back to one of those low interest
Yeah.
situations. Also, I have discovered that the investment side, if your bank has an investment partner, offers higher yield CDs. Okay? And you might get a little worried because, oh no, I'll pay a commission. Some guy will get, or girl will get involved. No, you can have a self-directed. You pay no commission. So essentially, it's a free investment account. So by exploring that with who's ever in charge, and you can make an appointment, you will be offered a higher yield, higher rate CD than the traditional CD offered at the bank side of the bank.
Yeah. No, yeah. So there are different, like I mentioned, different ways for us to put our savings aside. There is a certificate of deposits. You set a certain amount into that account. Let's say for maybe 6 months, a year. They give you a specific interest rate, and then you maintain that interest rate. The only downside with that is that there's a penalty if you withdraw the money early. So that's the only thing to keep in mind as well. So yeah.
And money markets are a good option too.
Yeah.
They're going to keep your accounts liquid. You just can only do like 6 withdrawals per month depending. But yeah, it's a good way to keep your account liquid and give you a high interest rate too.
Yeah. Okay. So yeah. I think you mentioned talking to your bank, talking to someone from your bank to see what services they have, if they can provide you or give you a higher interest rate, looking at different options. Maybe we have a person that knows about these things like Fidelity. Maybe they know how to manage that. Maybe they can help you as well. So, we can ask around to see what may be the best option. So it doesn't hurt to ask. Sometimes we may have to do our own research, but it's worth it. So yeah. Before I move into managing debt, any questions on savings or comments? Yeah.
I just when you were talking, it just reminded me that I think for a new saver, it's having the courage to have a goal for whatever you want to save.
Yeah.
And then the courage to go into a bank and ask the questions, what's the best thing for me? 'Cause
Yeah.
you don't know.
No, yeah. No, yeah. So,
It's frightening.
no, yeah, it is scary if you don't know about savings, if you don't know the different type of accounts. So, yeah, you can go to the branch, ask the options that you have available. So, yeah.
Yeah, because you're not going to see your money. It's not under the mattress where it's not going to earn anything.
Yeah.
And then that doesn't, inflation, so you're actually losing money.
Yeah.
But,
No, yeah.
yeah.
Yeah. Thank you for sharing that. Okay. And then someone mentioned that someone just opened one. I believe they opened up a savings account. So yeah, if you don't have a savings account, I do encourage you to open up a savings account. Like we mentioned, it is scary, but as long as we start, like I said in the beginning, if we start with $1, $5, let's start somewhere, just because it is going to help us in the long term. Yeah.
Another option for saving is that when you get your paycheck, do automatic savings from your bank from your checking to your savings.
Yeah.
And
Yeah, so if you don't have direct deposit, or maybe you don't want to set up your savings directly through your employer, you also have the option of doing directly through your bank as well. So you're able to move from your savings, from your checkings to your savings. So, yeah, thank you. And then, can someone tell me what the difference is between credit and debt?
Credit is the line of credit that you have, and the debt is how much you've already spent on that credit.
Yeah. Yeah. So yeah, pretty much that. It's credit is how much money you, the limit that they provide to you. Debt is how much money you owe. So let's say someone gave us a $5,000 credit card limit. We spend $3,000. That's our debt now. $3,000 is going to be our debt. So yeah, that's the main difference between those two. And I bring this question just because sometimes people think that in order to have good credit, you have to be in debt, when it's not always the what's it called? Yeah, it's not always the case. So we can have good credit without having debt. So as long as we know how to manage our credit, manage our credit cards, we should be able to have a good credit score without having debt. And let's say that we do have debt. Sometimes we don't know for which companies. Maybe we don't know the monthly fee, monthly payment that we're making, just because maybe we have automatic payments. So maybe we're not aware of the exact amount that we're paying. So it is important to have a list of who we owe, how much we owe them, and also how much the payments are, when the payments are due, and other important factors or facts could be your interest rate. How much is the interest rate on that specific credit card? So let's say that we do have like maybe 5 credit cards. We have almost to maxing out that credit card, or a few credit cards. We do want to work on reducing our debt, maybe eliminating our debt. We do have to have this information. So having this information is going to be the first step towards creating that plan. So again, this is a step that we can't skip. We do need this information in order to make that plan. Okay, and there's a lot of people that go into debt, and it's for many reasons. So don't feel like you're the only person. If you are in debt, don't feel like you're the only person that's in debt. Don't feel like you're behind your peers. Don't feel like it's just you. There's a lot of people that are in debt, and it's for multiple reasons. One of them is going to be purchasing assets. So if we want to buy a car, we want to buy a home, we are going to have to be in debt for that. Paying bills. So maybe we got behind with electricity. We got behind with gas. we get a loan, we use our credit card to make those payments, so now we have that debt in our credit card. Or maybe cover unexpected expenses. Like I mentioned, sometimes we have an emergency, we don't have the funds, so what we do is that we get a loan or we use our credit card. And now we have that debt in our credit card or in a personal loan. Yeah.
We have a question in the chat. Kelly asked, maybe I missed it. Once we pay off our credit card, should we close them? Doesn't that hurt my credit?
So yeah, we should try not to close our credit cards if we can, just because it is going to impact your credit score.
Why is that?
To be honest with you, I'm not too sure like why it impacts the, yeah.
It's the credit utilization, how much credit that you have. So when you change it, when you close the account, it's less amount of money to borrow. And so they base it on that. But I still close them anyway because it causes more problems.
Yeah.
Did me.
So yeah, it's up to each person. I recommend not to close them, but if you feel like you have to close them, that's a personal preference that you may have. So at the end, it is up to you, whatever decision you want to take. But for me, it's recommended that you don't close them out. Mm-hmm.
Somebody else mentioned, Allison mentioned, credit bureaus like to see older accounts, or at least what I've been told.
Yeah. So yeah, we're actually going to talk about that next month. We're going to go over exactly what they look at. And one of them is the length of history that you had with your credit. Mm-hmm. So I'm going to move into how that can affect our financial situation. So pretty much when we are in debt, we are compromising our future money, our future income. Just because, again, if we get a loan, we use our credit card, and we're doing the monthly payments, we are adding an extra expense to our budget, to the expenses that we already have. And if we were tight with the expenses that we had, we're going to be even more tighter because we added another expense. And that's how sometimes we start a cycle. We start a cycle of we're going to get a loan to pay this other loan. We're going to use a credit card to pay this loan, and then it's just a cycle that continues unless we don't sit down and actually see how we can reduce or eliminate those debts. We may not get out of that cycle, and we're just not wasting money, but we are giving money away. We're giving our money away to banks just because, again, they earn money through interest. So we do want to be careful with that. We want to see the options that we have. We want loans and credit cards to be our last option if possible. So let's see if there's other ways that maybe we can cover the cost, or maybe we can plan. We can look at our budget. We can look at our spending plan to see if we can maybe fit the monthly payment into our expenses.
Recommend it. I know when people have multiple credit card debt and they try to bundle it. A company comes in and they say that. And then you have one payment.
Yeah.
That's a bad idea.
It depends. So that's the consolidation. Some people also have the transfer from a credit card to another credit card. If the interest rate if it's a loan, consolidation loan, if the interest is lower than your highest credit card, then yes. But if the consolidation loan has an interest rate that's higher than your current credit cards, then you're going to be wasting more money. And also transferring your balance from one credit card to another one. If you have a promotion that you maybe have 18 months of no interest, maybe you can take advantage of that and start paying it off. So yeah, it depends on the person. Usually, if a person gets a consolidation loan, it's because they want to get rid of their debt. But sometimes if we don't have self-control, we're going to continue using our credit card. So now we're going to have two payments to make when the whole point of getting that loan was to only have one single payment. So, and also having debt, it does impact how soon we can achieve our goals. So let's say that we're planning for retirement. Maybe it's preventing us from saving more because we have debt that we have to cover first. So if we get rid of our debt, we have more money that we can use towards our goals, towards things that we want. Reducing debt or eliminating debt is going to make us feel better. So that's something that maybe that's going to be our motivation, that knowing that once we get rid of debt, we're going to have money for ourselves, money for things that we want to do. So maybe that's the motivation that's going to help us to create this plan. And then how does debt work? So there's two different type of main debt that most people get into, which is installment loans. We have the principal, which is the amount that you borrow. We have the term, so how long do you have to repay the principal plus the interest that they gave you. And for the most part with installment loans, they already include the interest with your monthly payments. Unless you have a variable interest rate, then it may change. But for the most part, it's a standard interest rate that they include with your loans. Then we have revolving credit. That's credit cards. So we do have a credit limit. So how much can we borrow? Our payment is based on how much we have used. And we do have a minimum payment, which is usually 1% to 5% of that remaining balance. And this is how banks make money. So they give us the minimum payment amount so we can stay with that, making those payments for 10 years because they're earning more money when we make those minimum payments. So if we can, pay the full balance. If not, pay a little bit higher than the minimum amount, just because it does make a difference with the payments.
That's a question you can answer. But as far as like variable debt, why do some people choose to go that route and not get like a fixed term?
Yeah, I feel like because when they get the offer, it's a lower interest rate than other and a standard interest rate. I don't know if you have an answer for that.
I mean, like, I think variable debt or variable would be like if someone owns a house and they want to do like a HELOC, like a home equity line of credit, where the rate is like fluctuating, like 1% every year.
Mm-hmm.
To them, it could go down. So it's like, oh, that's enticing. Maybe the rate's going to go down instead of actually going up.
Yeah.
So that's kind of my thought on it.
Okay.
I'm curious to know like what the benefit is, but it's probably just that like frame that they have.
Yeah, I would say most of the
Just
time I think credit cards are going to be like a fixed rate, not variable. I would say it's probably like a special loan, like a HELOC.
Loans.
Yeah.
Okay. Thank you.
Thank you. So we also have a high cost debt. Usually this is a small dollar amount. It's short term, but it does have a high interest rate. So one of those high cost debts is the payday or payday advance loans. So that's like Speedy Cash. Those are the places that we see. For the most part, they take most people, and it's usually like $400, $500 that they let you borrow. The main difference between a personal loan and a payday loan is that it's only within like 14 days that you have to pay back that amount. And the interest rate is about 300% compared to maybe like 25%. So it's a really high interest rate. And most people that get into this type of debt, the payday loans debt, it's a cycle for them because they can't get out of it because it's so high that they're just repeating that they're just getting a new loan to pay up the other loan. So again, if we can, let's try to avoid this type of loans just because yes, it's easy to access, but it's really costly. So.
You said 300%?
Yeah, it could be higher too. So, yeah.
That meaning like the moment you sign it, you're already past negative.
Yeah.
That's wild.
Yeah, so it's really high interest on those. Yeah. So we're going to move into methods that we can reduce our debt. So we have two different methods. The first one is the high cost debt first method. So with this one, the advantage is that we save money. The disadvantage is that our progress may feel a little bit slower just because we are focusing on the debt with the highest interest rate. And maybe that debt with the highest interest rate is our biggest amount. So it may feel a little bit slower with this method, but again, we do save money. And remember at the beginning, I mentioned that we have to know who we owe, how much we owe, when is it due, the interest rate. So this is when it comes into play. So we have to have a list of those debts, and we have to know the interest rate. So we're going to start with the highest interest rate. That's going to be the, number one on our list. And then we're going to go down to the lowest interest rate. And with how this works is that we're going to do minimum payments for all of them, including the first one, but adding something else to the first one. So if we are able to add maybe $20, adding $20 to the first one. If it's a bigger amount, even better, but if we can do $20, adding those $20 to the first account. And once we finish paying off the first account, we move that amount to the second account. And then I'll provide an example right now. In this example, we have 3 different types of debt. So we have credit card, we have medical debt, and we have a car loan. So we are focusing on interest rate. So the highest is the credit card company at 14%. Then we have the medical debt, which is 10%. And then we have the car loan, which is 6%. So let's say, just to make it simple, all of them are $25 minimum payment. So we're going to do $25, $25, $25, and we're going to add $25 more. So that's going to be $50. Once we finish paying off this amount, we're going to add those $50 to the second amount. So that's going to be $75 that we're going to be making payments towards this second one. Once we finish paying this one off, we're going to add those $75 to the last one. So that's going to be $100 that we're going to be making monthly payments to the last debt, which is the car loan. So maybe for a year, maybe 2 or 3 years, we're going to be making the same monthly payments, but we know that at the end of those 2 or 3 years, we're not going to have any debt. So that's the advantage, and that's the motivation that we can use to maybe use this method and reduce or eliminate our debt. And maybe we are not able to work on all of them. Maybe we're able to just work on 1 or 2. We can do the same thing with those two debts. So maybe starting with maybe 2, and then working towards the other ones as well. Has anyone else used this method? Has anyone used this method before? No? Okay.
I think I used it once.
You used it once? Mm-hmm. Okay. So yeah. So we have another one, which is the snowball method, which I think most people know. And this is the one that most people prefer, just because it feels that we're making progress faster. Because we're beginning with the lowest amount to the highest amount. So it does feel good knowing that we paid off the first account. And then we continue like that. So it does feel better knowing that we're seeing the progress. Because again, we're focusing on the smallest amount to the biggest amount. And then example, so same accounts, same amounts. So we have the car loan, which is $2,000, credit card, which is $8,000, hospital, which is $10,000. Same thing, adding minimum payment, let's say it's $25. We're going to add $25 to the first one. It's going to be $50. We finish paying that off. We add it to the next one. That's going to be $75. We finish paying that off, and then we move it to the last one. Same thing, we're going to maybe spend 2 or 3 years making the same monthly payment, but at the end of those 2 or 3 years, we're not going to have that debt, or maybe we're going to have less debt. Has anyone used this method? Yeah? How was it for you? How was the experience?
It was good because you feel like you actually accomplished something.
Yeah, not yet. Yeah, so that's, yeah.
In terms of money, which one do you save more?
The first one,
Okay.
yeah, because we're focusing on the interest on the other one, yeah. So, yeah, I mean, some people prefer this one again because they get motivated. Yeah.
It is psychological.
Yeah,
Yes.
yeah. So, yeah, correct. Yeah, so whatever is going to work for us, if
Didn't even
See?
think about the other one. Okay,
Oh, really?
honestly, I didn't. But
no, yeah. So I mean, it worked, right? So.
And also she could be earning more money if she goes along with, say, a company.
What was it?
She could be gaining more money, so then she'd be swifter at the next level debt.
Yeah.
Yeah.
didn't even think about looking at interest rates at the time. Okay, and
No, yeah.
monies, I didn't. But it looked like it was better.
Yeah,
I paid
no.
off the lower ones first and did the higher ones after.
Yeah, and like someone mentioned, it depends on the person. So whatever they prefer. Honestly, if I were to work on that, I would use the snowball method, just because it feels better. Some people do want to save money, so they start with a high interest rate. So it just depends on the person. Maybe you want to do high interest, maybe you want to do the amounts. So whatever feels better for us, we can go with that. Yeah.
If I realized interest rates back then, I probably would have done that,
Yeah.
but I didn't.
No, yeah. Yeah. Anyone else has used this method or any other method that maybe I didn't mention? You use this one? Yeah. Okay. Anyone else? Maybe they want to try this method? Yeah. You use the same one? Yeah. Okay. And then
I was also wondering too, it might be a good strategy, especially for something like medical debt, to try to negotiate a debt.
Mhm.
And it might be possible.
Yeah.
Yeah.
Yeah, and we can do the same for like credit cards, maybe even some personal loans. The only thing with that is that if we settle for a lower amount, especially with credit cards, the amount that they forgave, usually we have to pay taxes for it. And that's the only thing that we have to be careful with. So depending on what type of agreement we came up with, we may have to pay income taxes on that. So, yeah.
Do you know the amount of how much, like what's the limit of debt to be forgiven in order not to pay the taxes?
To be honest, I don't know if there's a minimum that you don't have to pay taxes for, but I know that if they send you the form, you do have to report it on your taxes. Yeah. Yeah. Okay. And then I did provide this handout. So in here we have those two methods. So we have the where is it? We have the high interest rate, and then we have the lowest to biggest amount. We can maybe use this to start, seeing what type of debt or what debts we can maybe pay off first. Any questions on these two methods? No? Okay. So we're going to move into not paying debts. So what can happen if you don't pay your debt on time? What was it? Fees, yeah. Mm-hmm.
100 phone calls.
Yeah, phone calls. Yeah. What else can happen if we don't make those payments?
The credit score will go down.
Yeah, credit score is going to be impacted. Mm-hmm. Yeah. Okay. Yeah, it could have went to collections. So yeah. Mm-hmm. So yeah, as people mentioned, there's the late fees. We have to pay interest, especially on credit cards. So sometimes that late fee is like $40, $60. And that's money that we could use for something else. So if we don't have a spending plan, we don't have a budget, let's try to make one, just because then it's going to help us know when those payments are due. So having a list, it does help. So again, if we don't have a spending plan, let's try to create one. You can contact your debt collector. You get contacted by a debt collector if it got sent to collections. That's when you receive hundreds of calls nonstop. So it is annoying, but they do want to get their money back. You could lose services. So if it was maybe the utilities, if you don't pay for the utilities, you could lose those services as well. And then if you want to get those services back, there's even an extra fee that you have to pay because they have to go to your house and they have to install those services again. So it's going to be an additional fee. So we do want to prevent this type of cost, just because, again, it's money that we could be saving or spending on something else.
It's not good for your self-esteem either.
Yeah. Also, it does impact our self-esteem. Yeah. I've been there. I've been where, I feel like everything's just coming down. So it does impact our self-esteem. So if we have a plan again, we know when those payments are due, we can come up with a plan. If maybe we don't have the money, we can contact the companies, we can contact the credit card companies to see if there's something that they can do to help us. So, yeah. Mm-hmm. Okay. Mm-hmm.
Or if anybody else might know, but I have a friend who is trying to figure out how to get in contact with her debt collectors. It was for her education, but their debt collector closed, their company. So now, I guess we just talked about it recently, so I thought I'd bring it up. How would she get a hold of paying that debt? Because they haven't sent her anything, I guess.
Do you notice that? Report? But I think she mentioned that they closed, right? The
company
the collections agency closed.
The collections agency closed. So now, just thought I'd bring it up. But retrieving that data back and paying her debt again.
Has she tried looking at her credit history again, her credit report? Because the most likely that debt is transferred to another
debt collector. So perhaps like the updated information would appear now. So I would suggest starting there.
Would you either get that from the bank or to get
The report?
The credit score report.
Yeah, so there's actually a website, annualcreditreport.com. You're able to access your report for free in there.
Oh, okay, great. And then she'll be able to see like the data, like
Yeah.
Yeah, it's most likely it got transferred to a different debt collector.
Yeah.
Thank you. Yeah, 'cause we talked about it.
No, yeah.
I'll let her know. Thank you.
Okay. And then what else could happen? Someone mentioned there's negative entries on our credit report. And then if we have a negative entry, that's going to drop our score, our credit score. If maybe it's like, usually with credit cards, if you have a large amount that you owe them, they are going to take you to court. For the most part, they do win. And what happened with that is that they're going to garnish your wages, maybe your checking accounts, savings accounts. If you get a refund during tax season, they may also take the money away from you. So again, we do want to prevent this from happening. We don't want them to take our money. So if we can come up with an agreement with them, let's try to do that. And debt collectors, they do have to follow rules. They can't be abusive, they can't be unfair, or they can't use deceptive practices. They also cannot call you at inconvenient times. So if you are at work, you can let them know that they're not to call you during those times. If they make threats or violence, you are able to report them. You are able to report them through the Consumer Financial Protection Bureau, through the Federal Trade Commission, and the State Attorney General. So there's different ways that you can report them if they are violating any of these rules. And where can you get helped? So there's different nonprofits. Maybe they specialize in credit counseling. We have our SparkPoint OC that can also help you create a plan. Also, sometimes the government websites may have some resources that you can access. And also going directly through the Federal Trade Commission, they can also maybe help you with that as well. Or your credit unions, your banks can also maybe help you, guide you to where to start. And sometimes when we are in debt, we do want to get rid of that. We want to escape that. There's different, services that are provided. One of them is the debt settlement companies. So pretty much you pay a company, they work directly with your credit cards, with your loans companies, and they come with to an agreement. Maybe they're going to forgive a portion of that debt, and then you're going to be making monthly payments to that company that you hire. But we do want to understand the process that they're going to take, the fees that they're going to charge, just because sometimes they don't provide that information, or maybe we don't understand the steps that they have to take. Because once they come to a settlement with your credit card company, they're going to close that account. So your credit score is going to drop after you finish the contract with them. And then there's the debt consolidation loans, the ones that I talked about. So only use it if you know that you're going to have that self-control of not using your credit cards, just because we don't want to have two payments, because the whole point of the debt consolidation loan was to have one single payment. So if we're going to continue using our credit cards, maybe this may not be the best option for us at that moment. Okay. Any questions? Yeah.
So I haven't done it yet. No, I hope not to. But when would be best to do to file for bankruptcy?
To be honest with you, I'm not too sure. I'm not familiar with when it would be appropriate to file for bankruptcy. I don't know, Rosa, do you?
I think that's very tricky. My suggestion would be to talk to somebody to get the best option, because sometimes we might feel a little bit hopeless and we might feel like bankruptcy is the best option for us. But in reality, that may not be the case, right? We could use some of these debt strategies or look into consolidating our debt, right? Look to what is that word? Adult working out. When we asked for the reduction in what we actually
Settlement,
or actually working towards settling some of our debt. So there's actually a really great organization that's called GreenPath that can help. Yeah, GreenPath that can help you with that and walk you through that process and decide whether bankruptcy is the right option for you or not.
Another question. Is it still true that after, say if you're in debt collection, is it still true in California that after 7 years it goes away?
Yeah, so it gets removed from your report, but the debt doesn't get erased. The debt is still there. Yeah. Any other questions? Yeah.
Generally, are student loans still categorized in like, are they in their individual like debt category, or it's just all debt as well? Any student loans?
I would say it's not under like the debt, like with like credit cards and personal loans. I feel like it's more like you mentioned, it's working towards our future, so that could be an investment debt. So it could be seen as that way. So yeah. Yeah.
Can credit unions help people that have some issues with all this?
Yeah, we definitely can. What you had mentioned, GreenPath, we actually started partnering with them, and
nice.
they're really, really good about like financial literacy and just teaching you things you might be unaware of. But when it comes to helping you get rid of debt, that's kind of our goal. We want to help you guys, as much as we possibly can. So if there's not always a cut clear option, we'll try to be as creative as we possibly can to find a solution for you. Because not everybody's going through the same problem, so we love to help as much as we can.
Yeah, thank you. Okay. Any other questions or comments?
Well, I have a comment.
Yeah.
What happened to the usury laws? Usury laws. At one time, there was a ceiling on how much you could charge interest. But now it seems like the payday law, you're talking about 100 to 100%. Something's wrong.
Yeah, and actually California is one of the states that has some limits because other states don't have limits on the interest rate that they charge. So yes, it's really high, but to be honest with you, I don't have an answer as to why there's no laws to prevent that.
I say 10%. That's
Yeah,
the highest.
yeah, should be that. Yeah. Okay. If there's no more questions or comments, that's the end of the class. That's the end of the slides that I have. So again, reminder: we have SparkPoint OC. If you want to work on your credit score, you want to work on your savings, feel free to scan the QR code to fill out this interest form. Yeah.
For like people who get out of debt and maybe like a year or two later get back in some type of consumer debt, from your guys' knowledge or experience, like what is it that causes those people to go back to that pattern? And if so, like how do you break that?
Yeah, I think it has to, we have to look at our values and also our behaviors. We have to work on that. We have to see what values we have, what type of behaviors we have. And like I mentioned, maybe having some limits just because depending on the person, it could be different reasons why they may like to spend money. But we do have to understand why. Because if we don't know why, we won't be able to stop that from happening. So I guess it's a little bit more personal on that person, like exactly what is making them buy more. Sometimes it's because they didn't have money as they were growing up. Maybe they didn't have limits on how much they could spend. So it's different reasons, but we do have to understand exactly what is it so they can work on that. Thank you. So our next class, last class, actually next month, is going to be going over credit cards, reports, and credit scores as well. It's going to be April 8th. All right, well,
Thank you, Adolfo.
Thank you, everyone. Thank you. Appreciate it.